so we got to wait for a second.
Yeah, I know. That way, if there's any noises that we want to edit out.
Oh, yeah, I don't edit.
Oh,
so, okay. All right, this is serious stuff. Hey, everybody, Economic Ninja here. I hope you're doing well. There are some big changes when it comes to mortgage rates and a new bill that's coming out, HR 7024. 7024. It is going to totally change the game. Now, I'm here with a buddy, actually a subscriber that I've gotten to know over the last year and a half, it's been?
Yeah, maybe.
Joe,
year and a half.
We're going to talk about some interesting things in the mortgage industry, things that people aren't seeing right now that are going to drastically change the mortgage industry, some things that are being hidden with Fannie and Freddie. And I want to start with this right here. And we're actually, just real quick, we're actually filming to everybody that has mortgage, the Mortgage Master course. We actually are adding 4 or 5 new lessons. You get it all for free. Thank you so much. And I want to announce, because later, a pretty big wig in the realm of credit and credit building and fixing your credit is coming to film the rest of my Credit Pro course. I'm going to add that today as a special bundle. I'm throwing it in. So if you want it, it's over 80% off both the Mortgage Master and the Credit Score Pro course. You will have no excuse. You will be so ready. You'll be crushing it and saving so much money. It's stupid when the next time you buy a house is or refinance a house. Okay, so that's down below. First off, out of CNET, mortgage rates fall on Fed Day. Today's mortgage rates for July 31st. It's interesting. It says here, inflation is moderating, but the Federal Reserve is unlikely to cut rates today, which we already know, right? Things are getting nutty. They're about to lower them, but they keep advertising these low mortgage rates. And Joe, let me ask you this. People, do they come into you because you've been a broker for a long time. How many years?
Started my 40th year.
That's great. So you've seen multiple cycles.
Yes.
Yeah. And so they come in with these expectations because the media is saying how low rates are, but now they're being slapped with origination fees and things like that. That doesn't always happen.
Yeah, the market right now, this last year and a half has not been priced. We're always the coupons, the anticipation of inflation cooling or not cooling, and it's been back and forth, right? So the market hasn't really taken a grip either way.
No.
And because of that, the spreads between a 0-point loan and maybe, you might see like in the average rates, they look a little lower than if you went and said, hey, I want that 0-point loan today. They might be 5/8 apart.
Yes.
Which is a big spread normally. That's not normal, right? But it's just the way the money is priced now. And it's because the market hasn't really given true direction. The Fed hasn't actually moved a single thing yet. They haven't cut interest rates 1 iota, right? So the market's trying to guess and anticipate. And actually the market's a little tired and the people are getting a little excited, maybe hyping, because they know it might be coming. It might be coming. This is all a definite maybe, right?
Yeah.
So you got to be careful, because if you buy into the hype, you might not really see the truth. And the problem is if you kind of notice, if you're really paying attention to the market because you're thinking about getting in to buy something, right? Or hoping to refinance, right? Whichever the need would be. You notice that they've been hyping that rates are going down.
Yeah.
But if you notice, the rates have been going down because the points have been going up on the ones that are kind enough to report the points in those weekly averages. So did the market really move? No, didn't really.
Let's get to what Fannie and Freddie's doing in a second. I want to explain something to everyone that is really, to me, exciting when it comes to an economic cycle, a real estate cycle, and then a mortgage cycle. As rates rise, there's usually no points on loans. Loans are freely going out. People are able to access lending so that they can go buy houses. Everything's going great. The bubble is forming. Well, as the Fed steps in and starts raising rates on a rate hiking cycle, this exact same scenario played out in the early 2000s. What happens is, as banks get closer to anticipating that the Fed has done their job, inflation is going down, the consumer are getting crushed, their unemployment's going up. What they do is they start to expect the Fed's going to pivot. They're going to start lowering rates. Well, what scares a bank is when they loan you money and they have a lot of money involved in the closing process, underwriting process, things like that. They're afraid that you're going to turn right around if you got a loan, let's say at 7% today, and 3 weeks from now rates go down and you want to refinance, that you're going to leave them, and thus all their cost investing into you is going to be taken away, and you're going to go refinance your loan. So what they start doing is they start adding points, because that is their sort of insurance policy, that when they lose that loan, that they retain that money that they put into you. And so the industry completely changes. And so when Joe's talking about lenders that are all of a sudden saying, hey, or the media, rates are lower, and you used to be able to go get a mortgage and not pay origination fees, but now you're faced with origination fees, and we're talking a lot of money. 1 point on a $600,000 loan is $6,000 of money you never get to see. It never comes back to you. It's just poof, gone. And that's why it's so important to teach people how to save money, right? Because saving money is making money. But now all the banks are expecting rates to start going down. They see the writing on the wall, and this isn't a good thing. When rates go down, it's because things go bad.
Well, yeah, I mean, I think if you look at the comments from the Fed yesterday, I think the most important point and the reason the consideration for rate cuts at the next meeting or two is that unemployment's over 4%, because that's kind of their signal that, hey, we've calmed things down, but maybe we've thrown too much water on the fire, and now we have to play the other side of the playbook, which is loosening, right, instead of tightening. So that anticipation builds hype. This has been, this has been everybody's. If you kind of paid attention, you really were paying attention, and you looked at November through December last year, those were the best rates in a long time, because they thought these rate cuts were coming in January.
That's right.
In February. And then they went, wait a minute, inflation is nowhere near where we want it to be. And then everything stopped and rates went up again. People go, oh my God, rates are going up again.
Totally.
Is inflation out of control still? And so now they think they might have it where they need to give it attention to the other side of the equation, right? And the markets are trying to get ahead of that and get you all excited. And sometimes the media, the way they report that, isn't always as straightforward and honest as we'd like it to be, I guess.
And this is something I want people to take away from this. If you're looking to buy a house and you're going to pay a point, what the other side of the equation, if you go with a loan that costs you a little bit more because you're going to pay a higher rate of interest, you got to do the math and divide how much extra your payment's going to be into that point that you're going to pay.
And to your point about, I think that's why the spreads were different, and personally, in my opinion, because they wanted you to be a little married to your loan.
That's right.
Right? So, but there was a positive. They weren't being unfair, the lenders, I don't think. Because normally every eighth we buy down costs a half a point in the normal market where spreads are normal. Right? Sometimes you get them for 3/8. And then all that affects when your break even is, if should I pay a point or shouldn't I? Right? And or several points, whatever. You look for the sweet spot where the quickest recovery is for those fundings, right?
Totally.
So the market was being fair, because sometimes you could pay 3/4 of a point and be a 0.5% below. You were getting a discount on the actual real cost. So it was an incentive to be married to your loan for a little while longer, and actually a hedge for the bank, because if the 0-point loan was 7.5 and you got 7 1/8 for a 0.5 point, you got a bargain in normal terms for buy downs. But they also built in a hedge that's 3/8 the market has to still go down before you even think about refinancing. So it kind of works both ways. It's not a one-way street.
This isn't an insult to Joe, but type 1 if all of a sudden your eyes just rolled back in your head, because you're like, this is a lot of information. But it's really good information, because Joe's been doing this for 40 years. And when I met him and we started talking about mortgages, the industry, and how to stack debt to save money, how to negotiate properly in a deal, a real estate deal, so that you have the lender essentially covering or financing your closing costs, it just was awesome, right? This is exciting stuff, and we cover all that stuff in the course. But I want to get into HR 7024, because we all know that type 2, if you think these bills should be very simple, that we can all read these house resolutions, but they stuff a lot of stuff in there. And we're actually going to show you something really positive about it if it passes, but they're also trying to stuff a bunch of crap down your throat. And I hate it, because it should be easy. But HR 7024, the Tax Relief for American Families and Workers Act of 2024, that just sounds really nice and rosy, right? Well, just a couple things. There's all these things. It's going to cost a lot of money, and there's a lot of stuff that's going to control us a little bit more. But one of the things in this bill that's exciting is how companies contact you when you go put credit scores out there, right?
Yeah, if you if you apply for credit, the credit bureaus now are selling what they call trigger leads. And the resolution we're hoping for in the mortgage industry is that this bill passes, because it would do away with their ability to make money if you apply for a mortgage, or you apply for an auto loan, or you apply for a credit card, or even apply for new insurance. They run your credit sometimes too.
Yep.
So all of these create lead opportunities for other insurance agencies, other lenders, to compete for that inquiry that you made with maybe your bank that you just want to stick with, and you don't want to talk to anybody else, right?
Exactly.
But because and I think this is unfair, because the credit bureaus are kind of a monopoly. There's only 3 of them, and we all have to use them if we want to get credit. And somehow they still have figured out a way to sell some more information.
Yes.
You know, they get paid every time we pull your credit, and now that's, I guess, not enough.
Yeah.
And now they're going to sell your information. They're not selling private, personal information, but they're selling, if they have your phone number or email on record, they can sell you as a lead to somebody to pester you. And I've had clients going, "What did you do?"
Exactly.
And I pulled their credit, and I had to leave my phone in my desk. I had a presentation to do. I had 60 texts and phone calls today for mortgages.
Yeah, down below, say that's happened to me. If you've ever put in an inquiry for a new credit card, or for
student
a
loan, auto loan, anything,
refinance on your house, and all of a sudden you're getting bombarded with calls. Well, this part of this bill would actually stop that, which is really exciting to me. But people need to understand this, but they also need to understand that they do need to build their credit. But a lot of people right now are afraid to build their credit because of these triggers that can happen.
Yeah, I mean, you know, as a dinosaur, 40 years, I'm not really a fan of credit scoring, you know, because I actually had to learn how to read a credit report, and you make decisions whether somebody was truthful or not and all that. And I thought that was more meaningful than a credit score, because sometimes an algorithm isn't fair, right?
Yeah, totally.
But in the realm of credit, though, we all have to live by this, right?
Yeah.
And some of what scares me most about the credit scoring world now, and the way people talk. I mean, there's a Credit Karma and all kinds of different credit score commercials.
Yeah.
It's like almost making you fearful, right? And you don't have to be afraid if you know how to use credit properly. And I think you can get over these fears and manage your credit well if you just do a little educating.
And let me throw this out too, and I want to close on this. I'm going to show you how to build your credit, and you don't need the companies to do this. There are these little tricks that people don't teach that I'm going to teach you guys, and over the next handful of months, I'm going to be talking about a lot of them on the channel for free. But as a matter of fact, I'm going to give the course away for free today. I'm going to bundle it up with this Mortgage Master, because we've seen so many people in the last 2 months see so much success in just a refinance or getting a home right now and saving thousands of dollars. Well, part of that is getting their credit score to be stellar.
Right.
But there's a lot of people, honestly, that we're going to be able to show. If you want a big apartment complex, if you're getting ready to buy a warehouse and you have a 720 score, I want to get you to an 8. And there's these little things that you can do yourself, or you could pay a company to do it. And even that, good companies, really good companies, don't even cost that much. I see prices out there for like $700 or $800 to fix your credit, and it takes them months to do it, but they get you up to that 800 score. They can't guarantee it, but there's little things. But I'm going to show people how to do it for free.
Yeah.
So that's what we're doing. I'm in Chicago right now. We're adding more lessons to Mortgage Master. I've got one of the big wigs in the realm of finance, a VP of a massive credit company, coming in today to also help me with that course. So look, I don't want to take up too much time. I'm going to put a link down below for the bundle if you want it. It's pre-filming for the Credit Score Pro course, but it's also including the Mortgage Master, which we're actually adding more lessons constantly for free, because industry is changing fast, right?
Yep, the industry changes as the market changes, you know, and it either gets looser or tighter, just like sometimes interest rates do.
So it seems like throughout the next year, we're going to be doing a lot more lessons on that course for people as that industry evolves.
I think you start with the beginner lessons to learn your benchmarks of the rules, right? Because the benchmarks have been around as long as I've been in this.
Yeah.
And then the market just kind of moves around with it, right? As it shifts. So you just got to stay up to date if you're active in the market. If you're not in the market, it's, don't lose sleep over it.
Totally.
But
there's a lot of money to be made
if you're kind of jumping in Now, because we see opportunity, right? Then, like the old rule, be prepared.
Not
Then
scared.
then we have to stay on top of it,
Yeah.
right? So,
Well, we got a lot to do. I believe the VP's coming up here pretty soon. So I got to go. But thank you so much for watching. If you guys want the bundle course, it's down below. I don't know how long I'm doing it because I just don't know how long it's going to take us to finish the Credit Score Pro course. So once it's done, and it'll be over. It's over 80% off. It's down below. Economic Ninja is out.